once again at Post 9. Now let's bring in Richard Clarida. He's PIMCO Global Advisor, the former Federal Reserve Vice Chairman. What a day to have you as well. I appreciate you being with us.
What a day, Scott. Where to begin?
Yeah, you tell me. What's most on your mind now?
Well, you know, typically it'd be the Fed minutes, but I think, first of all, the minutes were stale already, given that the meeting was well before Liberation Day. And then, of course, we had two things, at least in fixed income. We had a very, very successful 10-year auction. And then right after that, we had the announcement that you've been talking about the delay in the tariffs. So obviously, very risk-friendly announcement there. And but got to remember that the tariffs even now are much higher than they were, a month ago, and the highest they've been in some time. Although a lot of that is the U.S.-China piece of it.
A sigh of relief inside the Fed, you think, from the Fed chair? Same question I asked Steve Leisman, but you probably have good perspective on that.
The way I characterize it, Scott, is the numbers today, 10% across the board with a lot of extra tariffs on China, is probably in the ballpark of what they were penciling in, at least in one of their scenarios, maybe not their baseline. I think what was really probably of concern to them, and the chair indicated that last week in his comments, is that these numbers were much, much bigger than I think almost anyone, including the Fed, expected, which would have made their job even that much harder. But, you know, if these tariffs are in place, we're going to see some upward pressure on inflation, at least for a while, and potentially, you know, a drag on economic growth. But the magnitudes, I think, will be less concerning than they would have been otherwise. You
guys watch the bond market over there as close as anybody.
Yeah.
How close do you think we were to the Fed having to get involved by one way or another? I don't, whether it's buying treasuries or stopping QT or whatever tools they feel were, you know, in their box to deal with stuff like this. How close do you think we were to the Fed doing anything?
You know, if you use green light, yellow light, red light, I think we're at yellow light. I think you were beginning to see some indications, not only the magnitude of the sell-off, but what you were seeing in swap spreads, in the repo market. I think the lights were flashing yellow. You know, I wouldn't want to give you how close where we were, but clearly I think we'd seen enough in the markets, both in the yields and in some of the other signals, that it was definitely, I think, probably on their radar screen.
What do they do now, do you think?
Well, I think they take it day by day. You know, tomorrow there may be another surprise. So I think they take it day by day. You know, the chair said many times that they think monetary policy is well positioned. I think they're perfectly content to sit on their hands. And I think they have a little bit more breathing room now to do that if what we heard today is, in fact, remains in place. I do think that, and the minutes indicated this, and we've heard this a number of times from Chair Powell, I do think if the economy does crack, and I certainly hope it doesn't, but if it does crack with a rise in unemployment and a sharp slowdown in growth and employment, I think they will cut. But I think now the focus is just getting more information on how the tariffs are going to impact the outlook and the inflation data.
How closely will you all be watching what bond yields do from here, right? They're still elevated. We still have issues to contend with.
Yeah, oh, sure. Well, pick up on something Ed Yardeni said a moment ago. If you just look at the level of yields right now, it's basically in the middle of the range that we have been in really now since the fall of 2023, somewhere in the high 4s to the low 3s. And that would be consistent with, you know, a constructive, if not gangbusters, economic outlook, and also consistent with all the debt issuance that the government's doing. The budget deficit this year is going to come in at 6 or 7%, potentially more down the road. So that's more or less in the range that you'd expect, given the macro conditions. We saw the yield get down, of course, to the 380s last week on a flight to Treasury safety, but this looks more or less in the ballpark I think we'd expect.